A rally on a record. I'm saying that again. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up is a big day on Wall Street. We've got a Fed decision on the way, tech giants taking the earnings spotlight, and trade deals.
And on those earnings, Microsoft, Alphabet, Meta, they kick off the Mag 7 parade with spending on AI firmly in focus for investors.
The trade breakthrough in China is what I was talking about. May help Nvidia become the first public company in history to hit $5 trillion.
They have a landmark from Nvidia, but it's not them in focus after the bell. It's going to be the tech giants because we have 3 Mag 7 stocks reporting after the bell: Microsoft, Alphabet, and Meta. They account for $9 trillion of the $11 trillion in stocks reporting earnings today. It is the busiest in S&P 500 history. You add in Amazon and Apple, Matt, and that's a quarter of the S&P 500 from the tech giants we're getting this week.
$9 trillion. Well, Nvidia is half of that, and it's set to open actually at more than half, $5 trillion in market cap, after President Trump said he'll discuss the sale of Blackwell chips, which he called super duper, with Chinese leader Xi Jinping. As a result, the shares are up almost 4% in the pre-market.
Nvidia CEO Jensen Huang, Matt, also told Ed Ludlow that he hopes President Trump can make a deal with China.
We're currently assuming China is going to be 0% of our business. And if it comes back, if President Trump was able to negotiate, or if China would like us to come back to China, it's going to be a huge bonus for us.
Joining us now is Bloomberg Tech co-host Ed Ludlow in Washington, D.C. after that conversation. Ed, it seems like that's the way things are moving, given President Trump is saying that they'll talk about Blackwell chips. Is Jensen Huang the most influential CEO to the president in America?
Yes, although, whether the president meets with Xi and discusses Blackwell is completely separate from whether Jensen Huang meets with the president or any other Chinese officials and plays a role in it. The market, we're at a gain of almost 4% in the pre-market. Nvidia will probably open as the first $5 trillion market cap company. But we aren't really trading on fundamentals here. As part of yesterday's event, the interview and also the presentation on stage, Jensen basically updated Nvidia's near-term forecast by saying that they expect $500 billion of data center sales across the Blackwell Rubin family of chips over the next 5 fiscal quarters. But he was completely clear that that strips out any China sales at all. Their base case scenario is 0 China. And what we don't know in regards to what the president's talking about is there was never an idea that the full performant Blackwell generation chip was going to go to China. It was going to be based on a Blackwell architecture, but be deprecated and depowered in line with the strategy prior to today. And we just don't know what the status of that is.
But what we do know is if you get China sales in there, it could be trading at only 10x sales, which isn't massive for the most important growth company in the entire U.S. Stock market. What do you think about the valuations here, Ed? I noticed it was trading at about 44 times estimated earnings before the jump today.
Yeah, I think what's astonishing about the Nvidia story, and I'm a little bit jelly, to be honest, when the market opens, you'll probably break the red headline, first $5 trillion company in history. But people should remember that the jump from a $4 trillion valuation to a $5 trillion valuation has happened in just about a few months, a couple of months. And basically, the reason that the market traded higher, in part this morning, but also yesterday, is Jensen Huang giving enough evidence that the expansion has no end to it. He still frames this as being an early innings situation, and that will carry on for some time. Look at Nvidia's margins. Even with its commitments to onshore some of its supply through TSMC in Arizona, for example, it's still also a highly profitable company in an industry where the economics are brutal.
Yeah, gross margins. I'm looking right now at the 2024 was 74, right? And 2025 estimate 75.5. So pretty fat margins. Bloomberg Tech co-host Ed Ludlow, he did get to break Apple, eclipsing $3 trillion in market cap. Yesterday we did $4 trillion, so we had that.
And now we've upped it with $5 trillion.
Now we'll do 5.
I feel why Ed is jealous. I understand.
A tale of two earnings stories on the industrials. Boeing shares are wavering after the company reminded investors of its long recovery ahead, while Caterpillar soared on strong equipment sales. Let's get a read on the industrials. A Bloomberg stocks reporter Matthew Griffin. So Boeing, it's almost like a state-owned enterprise in that, even with a loss of $7.47 a share, people still buy this stock. Caterpillar's a different story.
Yes, it's really interesting to watch the difference in the industrial companies today. There are actually two companies that have both had pretty strong year-to-date share rallies. Caterpillar's up about 45% through yesterday's close. Boeing's up more than 25%. So sentiment for the two has grown more positive this year, but I think the earnings reports also encapsulate how investors feel here. Caterpillar has become the latest AI darling. Investors are really optimistic about their sales of backup generators for data centers. You saw that this quarter. Revenue grew 17% in the energy and transportation business. That stock is rising pre-market. Now, Boeing, on the other hand, their shares are down about 0.5%, kind of wavering here. They took a $4.9 billion accounting charge on a delay for their 777X jet. That's not going to debut till 2027. And so, whereas with Caterpillar, there's this optimism, AI, a new story there. Boeing, investors are looking for a recovery, for a turnaround. And this delay with a charge that's maybe bigger than expected is a sign that we just aren't quite there yet.
Caterpillar, we usually talk about saying something about the broader economy. It's almost perfect because it's a broader economy that's trying to pivot towards AI. But what about the sale of other heavy machinery? What did that tell us at Caterpillar, and does that say anything about the wider economy?
Yes, I think that's really a correct point there, is Caterpillar exposure to construction, to mining, to power demand, and through that to interest rates, to the strength of the economy, really a company that says a lot here. Sales revenue did grow in their construction business, but they did flag some headwinds there. They're seeing negative price realization. They're not able to sell their equipment for as much as they want, and they're facing tariffs on the cost bucket there. They're going to see tariffs of north of $1.5 billion this year. So that business is still strong. Investors think they're managing through well, but I think it does encapsulate some of the headwinds facing the U.S. economy.
All right, Matt, thank you very much for that. That is Bloomberg's Matthew Griffin. And we're going to have more with Boeing coming up, speaking with Jefferies analyst Sheila Kahyaoglu. Now, turning to another big event today, traders are awaiting a Fed decision that will be at 2 p.m. Eastern. Then we'll get the press conference from Chairman Powell. Joining us now on what to expect, let's get straight to Michael McKee, Bloomberg's international economics and policy correspondent in Washington. Mike, what are we expecting?
Well, it sounds like we're expecting a very short window of opportunity for me to get on TV today between 2 and 4 p.m. when we get all the tech earnings. And Jay Powell would be very happy with that. The Fed wants to go into this making probably as little news as possible. They aren't going to do a whole lot. We know they'll cut 25 basis points. They pretty much told us they would do that, and we'll get the Stephen Myron Trump-ordered dissent as well. There might be a no-cut dissent, but that's kind of unlikely. But Jay Powell's news conference is going to get closely watched for any signal on what they might do in December. And the betting on Wall Street is that he's going to suggest, don't look here. We don't know what's going on with the government shutdown, so we're not going to promise anything going forward right now. We might get a balance sheet announcement. They're very close to ending QT, and they might do it this week, or they might say we're going to do it next month, but it apparently is coming. Then they'll lay out their proposals for T-bills purchases in the short run and longer term, matching the duration of their portfolio to the overall curve. And they'll still have mortgage bond runoff in their portfolio because they do want to get down to Treasuries only. Be interesting to see if they say anything about possibly selling mortgage holdings to try to get there faster. And so after 2 o'clock, when we get that decision, you can look at the chart for the expectations for what we're going to get for a December rate cut. Right now, about 84% view in terms of a rate cut. But if Jay Powell manages to be successful, that might come down even a little bit more as we await the government reopening data and an idea of exactly where the economy is.
Oh, you think the government's going to reopen? That's optimistic.
Well,
Michael McKee,
someday, we hope.
Thank you so much for joining us. I kid, of course. I think we all are optimistic that the government will eventually reopen. Don't miss our special coverage of the Fed decision kicking off at 1:30 p.m. New York time, aptly titled The Fed Decides. Check on what's going on in futures right now. It is really extraordinary what we're seeing in terms of the index levels. Futures are up another 0.25%. Yesterday we closed at 68.90, I believe. So we're very likely to eclipse 6,900 and get closer and closer to 7,000 today. You can see NASDAQ futures gaining even more than the S&P futures as those tech stocks are a heavier weight on the NASDAQ.
Yeah, I mean, we're close to having 3 companies in the S&P with market caps greater than $4 trillion, and one of them above $5 trillion. So that's remarkable. Some of the other movers that we are looking at: Verizon lost 7,000 phone subscribers in the quarter, a challenge for the firm's new CEO, Dan Schulman, who's only been on the job for a couple of weeks, but he laid out a very aggressive plan for Verizon going forward, hence the rally this morning.
CVS raised its 2025 profit guidance for a 3rd time this year as it sees improvement in its insurance business. It reported a $5.7 billion charge on one of its healthcare units.
And Booking Holdings reported a full-year travel outlook that topped estimates as average daily rates lure guests. Unchanged this morning, though, in the pre-market, but we will be speaking to the CEO of Booking Holdings, Glenn Fogel, in the next hour.
And we got some breaking news here on Morgan Stanley. The bank has agreed to buy Equityzen, a trading platform for shares in private companies. It's the latest move by Wall Street to expand offerings for fast-growing startups. And the first deal under the Morgan Stanley CEO, I guess not new, but Ted Pick, is the newest. More on that deal next. This is Bloomberg Open Interest. All right, we have some breaking news on the Trump-Xi meeting. Apparently that will take place at 11 a.m. on Thursday in South Korea. Now, it's not clear to me if that's
I'm assuming that's South Korea time, which would be 10 p.m. tonight here in New York.
All right. So in any case, we're getting more on the TikTok of this meeting. And after, of course, President Trump mentioned Blackwell chips as possibly being in the trade talks, maybe for sale to the Chinese, this meeting is all that much more important.
That's already having its impact on markets, with Nvidia now nearing $5 trillion. Let's turn back to one of the earnings this morning, though, Boeing. And the company announced a $4.9 billion accounting charge and delayed for the debut of its 77X jetliner. For more, we're joined by Sheila Kahyaoglu, Jefferies senior equity research analyst. She has a buy rating on the stock with a $255 price target. Sheila, great to see you.
Thank you for having me.
And I know this charge was more than you and really the entirety of the street were expecting. So is this still a push forward, a path forward for Boeing, or is it more pain?
I thought these earnings were in line with what we expected. We had assumed about a $4 billion charge. They came in at 4.9, so about $900 million higher than we expected, and we had lowered our 26 free cash flow to around $3.5 billion. And the street's slowly come down over the last 45 days to that arena. So that's what we're anticipating. The 777X has an impact to free cash flow next year. But the results were in line, and I would say actually free cash flow core was about $400 million better. First positive free cash flow quarter in 2 years. So some momentum, but generally in line quarter.
So as you know, I often compare these shares to the shares in Airbus. And I always look at a 5-year window. It's just my default because the Bloomberg does that with the comp function. And I see over that period, Boeing has returned 50% and Airbus has returned 262%. Is this a situation where Boeing eventually catches up to Airbus? Are they, in this duopoly, always catching up to one another?
I think that means that Boeing has a lot of runway to go with its share price, right? Up to August this year, through August of this year, Boeing has delivered more planes than it did at all of 2024. They're stabilizing at 38 a month on the 737. They were only at 24 a month last year. On the 787, they're at 7, going to go up to 10. They were only at 3 to 5 last year. So they're improving on rates, and that's driving some of the positive momentum, which should help free cash flow. You deliver a plane on time, you receive, the funds for that, and you receive new orders, and the backlog continues to be strong.
By the way, ironic that their loss was 747, right? Which is their most iconic,
Do you think,
in my opinion, their best commercial airliner, at least that I've flown on.
Maybe it was rounded intentionally.
I was going to say maybe the loss wasn't as bad, but they tried to get it to 747 to.
I don't think you want to remind investors that you no longer make the greatest plane, commercial flyers have ever been on.
You are probably right.
I think it does go to show that President Trump has been a supporter of Boeing too, and so. With that, with the trade deals, I think that's been supportive of Boeing's order book.
I would say because also the FAA lifted its cap on 737 MAX production planes. How much of a difference is that?
During a shutdown,
right? And
that's the first. The cap was put in place in January 2024 with the Alaska incident. So now they're at 38, and they're allowed to go to 42 as of October. With that said, we do have 42 production a month in our estimates for next year, so that's in our numbers. But good news that the cap is lifted.
We were talking with Ed Ludlow about Nvidia, and he pointed out that Jensen Huang has made his estimates without including China revenue, although President Trump is likely to talk about that with President Xi on Thursday at 11 a.m. South Korea local time. Kelly Ortberg right now on CNBC saying that he's very hopeful for China talks as well. What's at stake here for Boeing in these trade talks?
China at some point accounted for up to 20% of the order book. It's much lower than that now. So clearly it's over the last 5-6 years, Airbus has been dominant in China. So that opens up a market. But again, Boeing's not relying on that with almost 6,000 aircraft in its order book. So they don't need China, but obviously it's incrementally positive.
Well, speaking of government relations and specifically defense for Boeing, they still have that contract dispute they haven't worked through yet with the workers in their St. Louis defense facility. How much of that is going to be a weigh on Boeing going forward if it doesn't get resolved soon?
It's 12 weeks into the strike, and the workers are about break even for what they're asking in wage increases. So we would assume that's resolved soon. And defense is finally turning a corner. This is a business that was losing billions in free cash flow per year. So now we kind of estimate a net neutral starting in 2027. So the big watch items to turn the corner are still the 777X and defense, but 37 and 87 are going pretty well.
Cool. All right, Sheila, great having you here as usual. Really appreciate your time. Sheila Kahyaoglu of Jefferies. She covers the airlines there, and we call her whenever we need the intel. Breaking news now on Wall Street. Morgan Stanley is buying trading platform Equityzen as a part of its private markets push in the first big deal for the CEO, Ted Pick. Joining us now is Sridhar Natarajan, Bloomberg's chief Wall Street correspondent. And how important is this? I mean, especially at a time when there are fewer and fewer public assets for investors to buy.
Well, first off, welcome to the CEO deal-making club to Ted Pick. It is a deal where no real price has been announced. They haven't disclosed the terms of the deal, so fair to say it's probably a sub-$500 million deal. So it is a bit of a nibble for Morgan Stanley. This is not the main course. This is not the real deals that they want to pounce on. But it is strategically very important. When you look back at James Gorman's tenure at Morgan Stanley, that was bookended by two massive deal sprees. The first one, right before he became CEO, Smith Barney really launched the big Morgan Stanley wealth management juggernaut, and towards the end, the E-Trade and Eaton Vance deal. But the deal that often does not get talked about, but is extremely important inside Morgan Stanley, was the Solium deal. It was a stock plan administrator for for companies where Morgan Stanley would go and make it their workplace channel to find employees who were getting these equity stock-based comp, bring them into their ecosystem. Similarly, you can look at the strategic importance of the deal. Do not look for the value and the size of the deal, but what it could do for Morgan Stanley in terms of entrenching itself in the private markets ecosystem, as you rightly pointed out, at a time when more and more companies are choosing to stay private for much longer. A lot of the deal making and a lot of the transactions are happening in their early stage before they hit the public markets, and that's where the banks have to find ways to make money, facilitate some of these transactions. At the same time, also find people who can come into the Morgan Stanley system. A lot of the employees who want to trade on a marketplace like Equityzen will suddenly come into a lot of money. They need to invest that money. And that's where Morgan Stanley will show up with other arms of its business and say, you will stay within the Morgan Stanley sandpit. That's the goal here.
I would say how much of this is just indicative of where wealth management, I guess for Morgan Stanley, but at all the banks is going, that they realize that they need offerings that look like something like private capital, whether it's bringing in this deal specifically with Equityzen or just having their own private capital offering.
Because you also have to see the read-through. Once you build these relationships with private companies at the early stage, you're also talking about follow-through activity in the investment banking pipeline. So it's the wealth management business that can also bring you a lot more investment banking business. And the wealth management business is a place where you're keen to grow assets. Investors are awarding consistent fee-based revenue making, and that comes from the wealth management business. So yes, it is extremely important. You can see that Jetfin, this head of the wealth management business at Morgan Stanley, is the one talking about this deal. And also down the road, several years later perhaps, but down the road, a possible CEO contender at Morgan Stanley because he's running a very important division.
Really interesting. Shri, thank you so much for bringing us this story. Excellent reporting from the team. That's Shri Natarajan. Thank you so much. All right, let's get a look at some of the movers that are on our radar this morning because we have had a lot of earnings already. Etsy sales topped estimates, but shares are down 6.4%. It's tapped its chief growth officer, Kruti Patel Goyal, as its next CEO.
And Kraft Heinz lowered its sales outlook as it prepares to split its business in two. It now expects 2025 organic net sales to be down 3% compared to last year, and the shares are taking a hit in an up market.
And Oreo maker, along with a lot of other goods like Ritz crackers, Mondelez cut its full-year outlook. It said that higher cocoa prices are squeezing margins and that it is a cautious consumer who will not pay up for chocolate. Shares are down nearly 5%.
Isn't chocolate recession-proof?
Apparently not.
Wow.
Maybe fancy chocolate is.
Maybe Oreos aren't recession-proof, but basic chocolate has to be.
I actually don't know what basic chocolate is if it's not like
well, I'm just
Oreos
saying, that's why, I mean, cocoa prices are going up, right? So, all right, let's talk about this right now with Bloomberg's managing editor for global business, Sheila Banjo. She joins us here on set, and obviously these are products that we all touch, eat, know, love, in some cases. So what's going on at Mondelez?
Yeah, I mean, both of them are facing, like you said,
Mondelez and Kraft Heinz.
Yes, sorry. Mondelez and Kraft Heinz are both facing, like what you said, which is higher input cost, coffee, food prices, all of those things. So taking those issues and having to address those. And then meanwhile, a consumer that is stretched. So what's been interesting is that so far across other companies, industrials, transport, whatnot, we've been seeing a pretty positive outlook. You're starting to see some of that negativity drop in there with some of the consumer names now saying, well, maybe things aren't as good as we think they are.
But some of them have done okay. P&G had earnings the other week, and they said people are still paying up to get name brand razors. Insert, Matt comments about how sticky it is when you get the kind of razor you want. So what's the difference?
Same with Oreos, right? You're not going to buy the store brand of Oreos.
I guess, maybe there are. Maybe in Oreos you'll buy a white label, but a razor you won't. I'm not really sure what does make the difference of these companies that are doing well in this environment and those that aren't.
Well, if you think about Kraft Heinz, for example, they have a sort of their own story to tell, which is they're splitting up into two companies. The name of the game right now is really, lowering investor expectations for what is happening at this company. They're going to break into two publicly traded companies in 2026. So they don't want to overpromise and underdeliver. They want to sort of reset everybody's expectations that, things aren't necessarily great, and then, bypass those expectations once they split off into two. Also, look at their customer base, the people who are buying things like Lunchables and Oreos and things like that. That is sometimes can be, not always, but can be a lower end customer base. And that's the group of Americans right now that are suffering the worst.
That's not the problem isn't that Oreos are too fancy, it's that they're not fancy enough.
I see. Oh,
yes.
It's interesting also because these companies, Mondelez was created, Kraft Heinz was created during the wave of consolidation. As you've been coming on and talking to us about companies, we're in a cycle of deconsolidation. So both, I think, could be good examples. One is for sure. Sheila Banjo, great to have you on the program. Less than 4 minutes until the opening bell. Liz Ann Sonders of Charles Schwab joins us. She says the market may have gotten a bit ahead of itself in terms of forward rate cut assumptions. Remember, it's Fed Day. All right, rally on a record. We're headed towards S&P 7,000. Moments away until the start of trading. I'm Matt Miller. This is Bloomberg Open Interest. Right now, futures on the S&P are up only 0.25%, but we continue to hit new record highs every day on pretty much every index. Yesterday, 68.90 was the close for the cash S&P settlement. The NASDAQ future is up 0.4%. Obviously, we have a ton of tech earnings today, plus very good news for Nvidia. Down at the New York Stock Exchange, Israeli mapped in New York, ringing the opening bell. Not sure what they do, but I'm sure it's exciting and timely. And here, this is exciting. Garrett right now ringing the opening bell at the NASDAQ. GTX is the ticker. Over the last 5 years, the stock has almost quintupled. It's up 381%. Those investors have a reason to smile.
They certainly do. And will tech give us a reason to smile after the bell? How's that for a segue?
Good one.
We're going to get a lot of the Mag 7 reporting in the next few days. Today, it is companies that account for $9 trillion worth of the $11 trillion that we're going to hear from today. So that's Microsoft, Alphabet, and Meta. All of them are up here at the start of trading. Can they hold on to that? And of course, you add on Apple and Amazon tomorrow, and that is a quarter of the market cap, Matt.
You're definitely happy if you own Nvidia. You know, a question we ask all the time is, okay, you own Nvidia, but would you buy it now, considering the run-up it's had? Well, it just continues to go higher. It is opening at a $5 trillion market cap. The share's trading for $207.88, up another 3.4%. This after President Trump said he'll discuss Blackwell chips, which he called super duper, with Chinese leader Xi Jinping. The CEO, Jensen Huang, expects sales now to top $500 billion in 2026. And as Ed Ludlow told us, that's without factoring in any Chinese sales at all. A big donut for China. So if those talks go well, the sky's the limit here. Huang also told Bloomberg he doesn't see artificial intelligence in a bubble.
I don't believe we're in an AI bubble. And the reason for that is we're going through a natural transition from an old computing model based on general purpose computing to accelerated computing. We also know that AI has now become good enough because of reasoning capability, research capabilities, its ability to think. It's now generating tokens and now generating intelligence that's worth paying for.
So Bloomberg Tech co-host Caroline Hyde joins us now, and that's really not news. I mean, that's NSS, right? Jensen Huang, obviously.
I have to explain NSS on your LinkedIn or on your X profiles later.
I mean, just check out NINSS on the Bloomberg terminal, and you'll understand. It would be news if he said they were in a bubble, but clearly Jensen Huang isn't going to say that.
And look, others have been saying maybe we're in a bubble. Look, Sam Altman himself has said he thinks we're in some sort of AI bubble. Bill Gates added to that chorus yesterday on other networks saying he thinks we're in an AI bubble. Some will be winners, some will not be paying off for the amount that they're currently spending. But what we're seeing at the moment is that a few key companies are deemed the winners of this entire super cycle. Nvidia, the main one, $5 trillion. It's up 50% year to date. It is therefore, thank you, S&P 500 run, because it's making up a fifth of the entire gains of this year. $5 trillion is extraordinary, considering it was only 4 months ago. It hit $4 trillion. But now we see the other players coming out, and the CapEx story is going to be so important. After the bell, you're going to hear from Alphabet. We know they raised last quarter to $85 billion per year in terms of capital expenditures. But that's going on things like Nvidia chips. You're going to be hearing from Meta, which in itself is becoming a hyperscaler of choice in many ways. It's about compute, where is their capital expenditure going? And then you've got Microsoft, the juggernaut that Bloomberg Intelligence thinks is going to raise it all the way to $130 billion for their next fiscal year for capital expenditure. That's about the entire value of their OpenAI stake as well. We're seeing just the amount of money flow in because for now, the revenues are also rising. The money is being generated for these particular companies.
I mean, just looking at SPLC on Nvidia, Microsoft
Supply
alone,
chain, folks, SPLC,
yes,
for those not lucky enough to have a terminal.
Okay, if you look at the supply chain for Nvidia, a much better way to say it, Microsoft has 19% of Nvidia's revenue.
Wow.
I mean, doesn't today also just underscores, yes, Nvidia has all this promise, but it's concentrated. It's a few bets on just the hyperscalers. that they'll keep spending.
And I think that is why what Jensen Huang on stage was really trying to show. The point is he's doing deals everywhere. He's going into Europe. They're getting all these other neo clouds. Think of the Nebius deals that are being done. Well, Nebius gets its chips from Nvidia, and they eventually then go to Microsoft because Microsoft's buying extra cloud from other players because it just can't build enough itself. You're seeing that with Nscale in Europe. But think about the deals that have just been done with Nvidia trying to broaden its remit, showing that they're going to be in the world of 5G, 6G. They're going to be doing deals with Nokia. You've been hearing them do it with Deutsche Telekom in Germany for more data centers. He's really trying to show that, like, I am bigger than the sum of just these few hyperscalers. But you're right, at the moment, the revenue is super concentrated. But you can only build cloud with companies of certain scale and size, it feels like.
All right, it's a fascinating story that we'll continue to tell, I'm sure, for years, and we'll watch your program for it as well. Bloomberg Tech co-host Caroline Hyde, her program kicks off at 11 a.m. Don't miss it, especially today. Let's bring in Charles Schwab, Chief Investment Strategist, Liz-Ann Sonders. And Liz-Ann, you know, we've been asking the question of people who already own these stocks. Would you buy more today? Would you add to these stocks today? Do you think investors are?
I think recently, and maybe this is a good news, most of the speculative fervor and a lot of the buying interest actually had moved away from the Mag 7, the big mega cap leadership names, and gone into more, esoteric micro cap, quantum drones, the meme stocks. And that's where you really saw the speculative juices. That has rolled over a bit. Goldman's quantum basket is down 25% from the October 15th high. And now only recently, I think you're seeing a shift of attention back into those mega cap names, maybe as a play on what look to be a series of fairly strong earnings to come. So I'd be a bit more worried if the aggressive buying had continued to be concentrated in those leadership names.
Liz, you and Kevin Gordon, the team, have been doing really excellent work about what's been performing. And it's a lot of the kind of junky stuff, like unprofitable tech, quantum computing. I know there was a little bit of the White House influence there. Retail, meme stocks. Is it troubling to you at all that some of these very low quality or speculative or risky type of equities are doing really well in this environment?
Well, it does suggest speculative fraud. Troubling, not so much, because they don't represent large shares of the cap-weighted indexes. So, and given some of the rolling over we're seeing there, even in areas like gold, it suggests you could see some rotations within those segments of the market by retail traders without it causing trouble for the overall market. So I think this market continues to be sort of two stories. You've got the market as measured by cap-weighted indexes, and you have everything else going on under the surface, not just within an index like the S&P, but more broadly. Even within the S&P, here's something fairly remarkable that's attests to just how much churn there is under the surface. First of all, yesterday was the weakest breadth for an up day in history. And that history only goes back to 1990, but in the history of having that statistics, the weakest breadth. Just since the April 8th closing low, when the S&P has obviously been on a tear at the index level, the average member within the S&P has had a 16% drawdown. In the NASDAQ, the average member just since April 8th has had a 35% drawdown. So the fuller story is told under the surface of these indexes in terms of leadership and rotations and where there's sort of speculative excess and maybe where there's opportunity.
Dani points out there were only 104 advancers on the S&P, to your point. Liz-Ann, obviously, that means there are 400 losers yesterday, and we still closed higher at 68.90. So it's frothy, so there's concentration risk. Still, financial conditions seem pretty loose. I mean, by that measure, and we have growth at around 3%, right? It was more last quarter. Plus, inflation is more than 3%. Does this really seem like an environment into which the Fed should be cutting?
Well, I think that, it's a lot they cut today. That shouldn't come as a surprise. But I have to think that Powell is going to keep the door open to being in some version of pause mode. This time would be a bit different relative to a year ago when the Fed ultimately paused, in part because of the mini riot in the bond market, where the 10-year yield was moving in the complete opposite direction of what the Fed was doing with Fed funds rate. So that was a message from the bond market last year. And then the results of the election, meaning the Fed wanted to just see what policy was going to look like. Now I think a pause, to your point, Matt, if they do it, or at least don't telegraph, hey, we're on a glide path here, expect more cuts to come, is driven, yes, of course, by uncertainty, but also the lack of government issued data, which, a Fed in data dependency mode, to your point, inflation still running above target. It's hard to make a case with broad financial conditions as loose as they are for a continuation of rate cuts on some sort of preset glide path.
Well, Liz, if that prior bond volatility was telling a certain story, what is the current lack of volatility saying? The MOVE index, the VIX index for the Treasury market, is at a 4-year low, despite what you're saying, that we're flying blind, we don't have data, there's uncertainty. What do you make of that?
So I think, it's hard to judge exactly what is moving the 10-year, but I think the move down to sub 4% reflects maybe a bit of a cloudier economic outlook. I don't know that it reflects some sign that inflation is set to come down. I think there's much more uncertainty still on the inflation side of things, but I think it does reflect maybe what you were picking up when we were getting labor market data of weakness in labor and some concern of slowing growth. And I think that's reflected in bond yields, but it's that relative calm in the bond market, and this is often not discussed, that I think is a big part of the reason why the equity market, in a broad sense, has done well. There is still that connective tissue between what's going on from a volatility and where rates are, longer-term interest rates, the 10-year being the yield most closely aligned with what the equity market does. And that's kind of an under-discussed story, that the calm and sub 4% on the 10-year is part of the reason for the strength in the equity market.
Well, it's calm in the bond market, anything but for these tech stocks. Liz, thank you so much for joining us this morning. Charles Schwab, Chief Investment Strategist, Liz Ann Sonders. And let's just look at Nvidia at the moment, because we are at $5.1 trillion in market cap for this behemoth, the first stock to top $5 trillion. I should point out, it is not just them. It is also an Apple that's trading above $4 trillion today. It's Microsoft trading above $4 trillion. So the first time we have 3 companies that have exceeded that benchmark, Matt.
All right, it's pretty jaw-dropping, the levels here, although maybe that's just because I've seen much lower levels in my lifetime. Maybe for the kids, this is the new normal. I hope so. Up next, energy equipment sales keep moving, keep the momentum moving for CAT. More on that stock next, which has been crushing it. You can see up 60% year to date. This is Bloomberg Open Interest.
Let's get you some top calls. Some of the analyst action that we are watching this morning. First up, Wayfair came out with a third quarter beat. Shares falling, though, down 1.4%. Gordon Haskett lifted its rating to a buy. Bank of America also upgraded the furniture retailer, saying it's outpacing a flat industry thanks to logistics and loyalty. Jefferies, though, flagged the company's heavy AI focus as a growth driver. Next up, Bloom Energy. They are gaining 12.6% after beating third quarter estimates. Analysts called it a solid beat. Evercore and JP Morgan both hiked price targets. They cited Bloom's manufacturing capacity and rising AI-driven power demand as major tailwinds. Finally, chip maker Teradyne hitting highs after reporting a strong third quarter beat and outlook well ahead of expectations. Those shares also up a lot of huge movers today. JP Morgan highlighting the highest revenue since 2021. Stifel says the outlook even topped their bullish estimates, Matt.
All right, so some upgrades there and big gains for Teradyne. Let's turn back to this morning's earnings. What we know so far, Caterpillar topping estimates as energy equipment sales soared in the third quarter. Revenue jumped by 10%, led by its energy and transportation unit, which is its fastest growing segment in the business. And joining us now is Chris Ciolino. He covers industrials for Bloomberg Intelligence. Chris, what do you make of CAT and what do you make of this sector? Is it getting expensive at this point?
Yeah, I mean, certainly valuations are creeping up there, but despite pretty lofty expectations coming into the print, and even a bigger tariff headwind, these results were really quite strong, really driven by better than expected volume across all three of their core businesses. But again, to your point, the strength continues to be in the energy and transportation unit. But I think what's even more encouraging here is that we saw orders accelerate in the quarter and backlog improved sequentially again to another record level. So we're at $40 billion here. That's going to provide above average earnings visibility as we think about next year.
One of the big strengths, Chris, was its power generation equipment, specifically because it's being used to power data centers. Is Caterpillar now an AI company, Chris?
I think a lot of people like to think so. I mean, at the end of the day, this is still going to be a cyclical company. But yes, energy and transportation, and particularly that power gen business, continues to be the fastest growing part of the portfolio, very margin accretive. And I think there's probably a very significant long runway here for them to continue to grow that business. Right now, power gen's really only, call it 12-15% of the overall portfolio. I think there's significant opportunity here long term to expand that.
I mean, power, the grid, U.S. infrastructure, desperately in need of ever more investment. Is this entire sector really poised for continued growth?
I think so. I mean, at least in the near to intermediate term, I mean, the backlogs extend multiple years here. They're bringing on a lot of capacity, particularly with their large engines. That's going to increase by more than 125% through 2028. You'll see that come on incrementally next year, but I think 2027 is when you really see that step change. So I think you're looking at least the next, 3+ years of pretty good visibility in that business.
All right, Chris, thanks very much for joining us. Chris Sheila there of Bloomberg Intelligence, talking about the gains we see on, for Caterpillar and on the S&P 500 Industrials Index, which is now trading at 28 times trailing earnings. Coming up, CVS boosts its full-year profit outlook despite taking a nearly $6 billion charge, and the shares rise more than 3%. More on that next with Katie Greifeld. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in the stock market here. 20 minutes into the session, S&P 500 climbing to 69.14. So it just continues this upward march. I'm not going to say melt up, but I'm going to guess some people will use those words. NASDAQ 100 gaining 0.5% to 26,000. We do have the Dow Jones Industrial Average here. We're headed for Dow 50,000. Kids, which is pretty amazing. Right now, Nvidia up 4.6%, so well over that $5 trillion market cap. Microsoft going the other way after a rally yesterday. Microsoft yesterday passed through $4 trillion. Again, Alphabet shares right now up and Meta down. We're going to get these big earnings after the bell. Pfizer cut its outlook drastically, and as a result, the company has lost almost half of its value. And CVS, we're going to hear about right now from KG. DB?
What a great setup. Yes, indeed. CVS getting a boost thanks to its Aetna business. The company's CEO, David Joyner, telling Bloomberg, quote, the multi-year Aetna recovery is in full swing. And you said it, Matt, here with more on her interview is the co-host of Bloomberg's The Close, Katie Greifeld. Katie, great to have you on here, a homecoming, if you will. So, okay, a boost to the profit outlook, but they did have this big charge. Mm-hmm. I guess it's the boost that's showing through with their earnings.
Well, that was kind of the debate that you saw in the pre-market, because initially these headlines came out at 6:30 and shares sank as traders sort of digested that impairment charge. But as you really dig into the details here, probably the positives maybe outweigh the negatives a little bit. You take a look at them raising their 2025 profit guidance. That was actually the third time this year that they've actually raised their outlook. They also beat when it comes to the analyst expectations in the quarter that was. And again, we spoke to CEO David Joyner, who just passed his one-year mark as CEO, and he said, as you mentioned, that a big driver of that was what you were seeing with Aetna. You remember back to 2024, CVS shares were down by about 43%. And a lot of that was that Aetna and other insurers, they really struggled to price their plans properly. That was a big reason why Joyner was brought into this role. So one of his mandates was to basically get a grip on medical costs and other features there, other operational improvements in the Aetna business. And it looks like it's bearing fruit.
Yeah, cost cutting is one of the things. If I go through the street wrap on the Bloomberg and look at what a bunch of analysts are saying, almost all of whom are either outperform or overweight. So they're all buy on this stock. Cost cuts is one of the other things they mentioned in terms of obviously the top line has been good. All three segments are doing well, but they're cutting costs at the same time.
Exactly. And they're making hard decisions, too. And that's what where it really wraps into Oak Street. So for those who weren't familiar, Oak Street, that's their division that's basically primary care clinics for seniors. And they bought this business for more than $10 billion back in 2023. But they made the decision to basically write this down. CEO David Joyner said to me that as a result of the slowing clinic growth and the fact that we're closing 16 clinics, we had to right size the value of the asset. So we took that $5.7 billion impairment charge. So it's going to close those 16 clinics by the end of February. It doesn't plan to open any in 2026. So again, there's that real focus on just right sizing overall, cutting costs, and improving really important parts of CVS, which obviously include Aetna.
You can do this when you're a new CEO, right? You can come in and throw everything out, including the kitchen sink, and investors like that clean slate approach. So this could be a positive, really, too.
Yeah, I mean, take a look at the stock in 2025. It's really breathtaking. I had to double check this a few times. Up 95% in 2025. That comes off of 3 straight years of declines, and like I mentioned, down more than 40% in 2024. So the expectations for this company were so beaten down, and when you come in with a big mandate and you act upon it, you can see shareholders reacting to that.
All right, Katie, thank you very much. That is Bloomberg's Katie Greifeld. Of course, pay attention to the close. She'll have more on her interview with the CVS CEO. Coming up in the next hour here on Open Interest, KKR's Henry McVey will be joining us at the top of the hour to talk markets, the Fed, and more. It is a Fed decision day alongside all those big tech earnings. We'll also get Booking Holdings CEO Glenn Fogel on the strength in the travel sector, though U.S. consumers are paying less on ticket prices. We'll also speak with Kanye Anderson's Rabil on his new acquisition of outpatient properties. You are watching Bloomberg Open Interest on a day when Nvidia hits $5 trillion in market cap.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. It's a day heading towards another records ahead of a Fed decision and big tech earnings.
Yeah, we have a major milestone, Nvidia becoming the first public company in history to hit $5 trillion a day after Microsoft and Apple passed through $4 trillion.
And meanwhile, Microsoft is among the companies joining Alphabet and Meta, kicking off the Mag 7 parade of earnings, spending on AI firmly in focus.
And as Dani mentioned, a Fed decision is on the way in Washington. We're expecting a cut there, while President Trump gears up for his meeting with President Xi in South Korea.
Meanwhile, Apollo co-president Scott Kleinman said that he expects private equity deals to persist at a slower pace despite expectations for Fed cuts. He spoke with us yesterday.
I think there was a lot of optimism that rates would come down pretty quickly. Rates are starting to soften, but still we believe the rate environment is going to stay higher for longer.
We are expecting a Fed cut today. Let's add another voice, an expert voice to the conversation. Henry McVey, KKR's balance sheet CIO and head of global macro and asset allocation. Henry, thank you so much for joining us. It does feel like this bizarro world where on one hand, we're talking about the Fed cutting and continuing to cut, labor market weakness and equity prices at all-time highs and spreads at all-time tights.
Yep.
Is there some real tension in that?
I think, look, the tension is on the inflation front, right? The Fed's already told you they're going to miss their mandate for 7 years in a row. Probably very few of your viewers have invested in a period like that. The offset of that is there's not a lot of supply in the market, and the S&P is being bought back $1 trillion, $1.5 trillion, and we see a lot of annuity buyers coming in, keeping credit spreads tight. The other thing is, I think this is a lot like the 1990s where we were getting a productivity boom. And so when you look at the S&P kind of revenue per employee, it's breaking out. It's breaking out to the upside. The market is picking up on that. I'd say today, I think the U.S. market will continue to perform. We're probably most excited about, on the margin, what's happening in Asia. There's a ton of corporate reform taking place in Japan. That's been our second most active market. Korea, cheap market. They're trying to follow the Japan playbook. And even China, I go there all the time. There are things that are starting to signal that Xi maybe appreciates this intersection between national security and economics, and the stock market's doing a little bit better. So as the dollar weakens, I still think the U.S. is the market that you want to be in, but on the margin, I'd be taking a little bit more out and going internationally, particularly around those three markets I highlighted in Asia.
We're going to talk about Asia and trade in a moment. We're going to bring in our reporter in Asia with President Trump. But I want to focus in on the 1990s comparison. Okay. We had Paul Tudor Jones on here earlier this month, and he made the same comparison, saying, October of 1999 is a lot like October of 2025. And of course, the NASDAQ still had a long way to run at that point, right? Still doubled into March of 2000. Do you think we're in that same kind of bubble-ish environment?
I think it's earlier stage. When you look right now, the CapEx and the R&D around AI is about 5% of GDP. Typically, it usually gets around 7 or 8% of GDP when you have a real bubble. So I don't think we're quite there yet. I think you'll hear from all the earnings today, the companies have to spend on this. Ultimately, over time, I think the value is going to shift from the enablers of AI, which is utilities, industrials, and tech right now, to the applications of AI. And that probably will be more broad-based. That's exactly what we saw during the 1990s. But very similar, in 94, you had a bond market upheaval. That was 2022. People moved to the sidelines. Everybody's been calling for a recession the whole time. We've had terrible manufacturing data, but the services economy is doing well. And a little bit on the manufacturing side right now, it's hard to hurt yourself falling out of the basement window. I mean, we're already at pretty low levels. We have a pretty interesting window. We own 150 to 200 companies. We continue to power forward. I would say some of the hiring is moderating. The government data, when it does come back, will look a lot worse, because ultimately DOGE will take the government jobs down, and that's somewhere between a third and a half of jobs. I think people haven't focused on that. So the headline data may look worse than what we're seeing at KKR, or the weekly jobless claims, or what you see in ADP, which are all reliable sources.
Yeah, I know in September you had written that had it not been for some of the supply issues with labor, we would have been looking at an unemployment rate that looks something like 5%. Yeah. And it does feel like every day there's a new headline like X company is letting go of workers. Scott Kleinman told Matt and I yesterday that the question being grappled with right now is to what degree AI is responsible for some of those replacements, especially when you look at KKR's portfolio companies. Is there a real trend of that happening?
So let's start with the public data. Remember, the single biggest driver has been healthcare and education. It's been about 100% of job growth over the last 12 to 18 months. So when you get the big headline number, you really have to dissect it, and what you see is that sector has been the main driver. You are to your point, you are starting to see joblessness in the college grads. They're having a harder time getting jobs, and then the government is what I said. What's happening though in the headline level, though, remember, it's not just demand slowing. The point you're making is an excellent one, which is what we were flagging, is the supply is slowing. So it affects the denominator, which makes the unemployment rate, if you adjust for that, actually closer to 5. And so if I'm a Fed governor right now, I've been trying to have the swivel between inflation and employment. And until recently, would have been much more focused on inflation. What I think we've been signaling, on our cuts and our forecasts, is that they need to shift to employment. I think the absolute level of rates in the U.S. is too high for the economy right now. You see this in the low to middle income spending, you see this in leveraged structures, and ultimately you see it in housing. Those are all critical variables to the economy. So I think the Fed needs to cut. I also think they need to signal that they're going to stop QT. And we'll probably do that at a level that's a lot higher than what we've seen in the past. But I do think the inflation story is going to be, this higher resting heart rate for inflation this cycle. You guys have been reporting on this, and I think you've been spot on, which is this time it's different, right? We've been talking about this regime change at KKR, where you have bigger deficits, more geopolitics, messy energy transition, and stickier services inflation. That's why I think even though they lower rates, they don't go back to the lower bound that all the reporting you've been doing for years, that you can kind of throw that playbook out. And why is KKR doing more in infrastructure? Why are we doing more in corporate carve-outs? Why are we doing more in asset-based finance? Those are all products that should excel in a world where you have higher nominal GDP and higher inflation. And I think the Fed is going to be forced to cut into that a bit, not as much as the bulls think, but they're going to have to continue to bring the absolute level of rates down. It's not about financial conditions. They're pretty easy right now.
Right, they are. I mean, I look at FCon Go on the Bloomberg terminal all the time, and they look pretty easy. My question is, lowering rates will help maybe someone buy a house or maybe help someone buy a car, and Lord knows they need the help because the prices are so high. But will it bring jobs back if AI is replacing those jobs?
I think there are a couple of questions in there. One is we can't celebrate rates being cut because when they went as much as we did in the past, the beta to rates was much higher, right? Because remember when they raised rates, most consumers had termed out. So on the way down, it's not like it's going to change overnight, that you get just the benefit and none of the pain. So I think the easing of rates will probably affect 26 and 27. On the AI stuff, I have a little bit of a different view, which is I don't think it's going to, this is what people said in the 1990s with the internet, it was going to disintermediate all these jobs. I do think certain industries are going to be under a lot of pressure, but at an aggregate right now, we need workers in the U.S. I mean, one of the key themes, I go all around the world traveling, going to KKR's offices, meeting with companies, the demand for skilled talent right now is at an all-time high. And so what are the big themes, investment themes that come out of that? Worker retraining. We've been doing a lot around that from investment. Employee ownership, we're doing a lot around that. Productivity enhancements. There's a lot. I mean, you can come in every day and say the glass is half empty. I think we've been saying they're writing, and is that the glass has been half full because there are lots of areas that serve as foils to all the madness that you guys have to report
But Henry,
report
just
on.
Quickly though, if it is the 1990s and the ramp up, couldn't a glass half empty be that there is another side to this, that we go too far, and if it's an economy becoming more dependent on AI, then the downside looks ugly?
So we're going to get there because typically what happens is capital overspends. I would just caution that when you look at just the CapEx and AI in the first half of the year, it was greater than all the growth in personal consumption. That's a huge number. So these things tend to play out, but they take years, not months. And so I would caution on trying to call the top in the fourth quarter of this year. Ultimately, though, what will happen is returns get diminished because capital comes in and competition increases. And that's the law of the jungle in terms of financial services. And that's probably what's going to happen, but I don't think that's today. So what should we be doing for our LPs and that we invest on behalf of is we should be high grading who our counterparts are, finding the companies that really have real cash flow. Don't speculate. Don't adopt the thesis of if you build it, they'll come. That's what happened in 2000 and happened in 2001. What KKR is, and we were talking about this before the show, we're doing a lot of structured deals right now where we're getting guaranteed cash flows, and that's the way you mitigate some of the downside. So I can't speak to the overall industry. There's a ton of capital coming in. I would also say this whole notion of the private markets are becoming more like the public markets. Linear deployment, diversification, correlation, all those portfolio tools that have been in the public markets for 20 years. When I joined KKR in 2011, our portfolio managers really started to implement that, and I think it's kept us out of harm's way, and I think that's where the industry's going.
All right, Henry, you're going to stick with us because, as I said, we do want to talk about trade. We want to talk about Asia, which you've highlighted in your recent research. Henry McVey of KKR is going to stay with us. And we're going to go to Tyler Kendall in Asia because the U.S. and South Korea finalized a trade deal ahead of President Trump's meeting with Chinese President Xi Jinping. We're getting more details on that meeting as well that we'll bring to you. We're live in South Korea when we come back. This is Open Interest. Let's get to high interest now. A look at what's making headlines around the world. A distressed debt fund just took over one of America's biggest malls and wiped out a lot of investors in the process. Black Diamond Capital Management gained control of the Palisade Center in West Nyack, New York, after buying most of the bonds tied to its mortgage and forcing a sale. The deal triggered about a $231 million loss, including a big hit to investors who were holding what was once AAA rated debt. It's another warning sign for commercial mortgage bonds backed by old malls and office buildings still struggling after the pandemic. Morgan Stanley agreed to buy Equityzen, a trading platform for shares in private companies. It's the first deal for CEO Ted Pick and the latest move by Wall Street to expand offerings for fast-growing startups, though the price and the other financial details were not disclosed. Uber plans to start offering driverless rides in the Bay Area next year using Lucid SUVs. Testing is already underway and more than 100 cars will be on the road soon. The move puts Uber in direct competition with Waymo's robo-taxis in San Francisco, whose driverless vehicles have become commonplace in the city. Uber still needs permits to operate without drivers, but says it's working with regulators. And the White House last hour said President Trump will meet with China's Xi Jinping in South Korea at 10 p.m. New York time tonight. That's 11 a.m. local time there. Trump says he plans to cut tariffs on Chinese goods as part of talks with Xi Jinping to curb fentanyl exports. Trump also signaled that he's open to giving China access to Nvidia's top-tier Blackwell AI chip, calling it super duper and driving Nvidia's market cap over $5 trillion. Dani?
And helping the overall market rally. Let's get more of the details. Bloomberg Washington correspondent Tyler Kendall has been traveling with the president. She joins us now on the ground where it is late in South Korea. Tyler, 10 p.m. local time here in New York, 11 a.m. your time. What are we expecting in the conversation between the two world leaders?
Yeah, hey, Dani. Well, it really is starting to feel like the contours of any potential U.S.-China agreement is expanding beyond what we originally expected to be just a pullback in the recent escalation of tensions, right? We started this week coming out of the trade talks in Malaysia, where we heard the Treasury Secretary Scott Bessent suggest that we were going to get an extension to the trade truce in place and set to expire on November 10th, and also some mitigation when it comes to recent actions, like China was going to start to resume its purchases of U.S. soybeans, which Bloomberg News has confirmed, and that also China was going to scale back, delay some of its export curbs related to critical and rare earth minerals. But as Matt mentioned, we now have President Trump floating that he's going to bring up Nvidia's Blackwell chip with Chinese President Xi Jinping. Of course, this would be a big development for the company, which has been trying to re-enter the Chinese market since 2022. I will mention that President Trump a few months ago had floated that he would consider allowing a downgraded version of this Blackwell processor to be sold into China. We are, of course, still waiting details on exactly what's going to be discussed, what's going to come out of that meeting. But I know that I'm in Korea, but I will give you the Washington angle just very quickly, which is that if you're a defense hawk waking up this morning in the nation's capital, you might be in a tricky position if you've previously advocated against these types of sales over national security concerns. So that is something to watch really closely here, how the administration frames the issue around national security, considering, Matt and Dani, a lot of their tariffs, particularly those enacted under Section 232, are enacted on the grounds that there are these national security concerns when it comes to our competition with China.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall coming to us out of South Korea. She is traveling, of course, with the president. Still with us is Henry McVey, KKR's balance sheet CIO, head of global macro and asset allocation, and someone who's just spent some time in Asia himself. I was reading your thoughts from the road, and you were in Japan and China. Yep. What are your takeaways from the news we have today, and how does that dovetail with your experience in Asia?
Look, I think the Asian markets are going to perform, weaker dollar. I think the news that was just reported is what we hear on the ground. Everybody I met with in China said there's going to be a deal. So I think tariffs come down 20 or 30%. I think the two entities, particularly President Trump and Scott Bessent, want to get a bigger deal done. And then you have the hawks, both Republicans and Democrats, under them. I think they'll probably, have the potential to do a little bit more because I think the two entities need each other. We need rare earths, and ultimately they need to boost their technology infrastructure. And so I think they're going to try to find a way to meet in the middle. I don't think it's going to be perfect and will be tension. And we clearly have left the decades that I used to go there where China was going to consume or China exported. This is a very different China that we see right now. They're huge in industrial automation, they're huge in digitalization, and they're really big in the green economy. I think they're going to continue to export that, and that'll create a little bit of a deflationary impact on the world. But even with that said, I think these two entities at the top level want to try to get something done, and I think the markets both in the U.S. and in China have been responding to that. Japan, on the other hand, that continues to be our go-to market. Big corporate carve-out market, going back to Abenomics. They wanted to make that better. We've turned over a lot of prime ministers recently, but the corporate reform story is alive and kicking, and it's an incredibly powerful story. Cheap financing, negative real rates, people need to invest, and the corporations want help making their businesses better. So that's a good backdrop. It's a great backdrop for what we do.
And I know KKR has been very active there. Henry, I have in my mind a chart that you put out earlier this year, and it looked at a bunch of different asset classes, be it private capital, cash, or the global ag. And if the spread was like this in years past, the chart you had is here's where we are going forward. Everything is going to start to compress. Does that suggest it's just an environment where, one, we should expect lower returns, and two, alpha is just harder to come by?
Well, one, I agree, one, I disagree. On the lower returns, I would agree with you, Dani, that I think that you're starting with higher multiples, rates are lower, and margins are high. So that by mathematically, your expected returns go down. I actually think the alpha opportunity is higher. You're starting to see this in hedge funds. They're starting to perform again. Macro managers are doing well. And what we're doing is the bread and butter of what KKR does, many more corporate carve-outs. So if that's not what you do well, that's going to be an issue. Public to privates. There's a lot of stocks that have been left behind. You spend a lot of time reporting on the stars. What's happened is a lot of companies have not performed. They want to go private, be out of the limelight, and they want to use that capital. They want to use KKR as a partner to grow, or you're seeing what you reported on with Harley-Davidson, or what we talked about, just recently with the Dr. Pepper, where these companies are splitting up and they want to have a better corporate footprint. That, this whole idea of going from kind of capital heavy, lower multiple to capital light, or some type of accelerating growth. When you divide the S&P into its returns, the companies that are growing faster with the higher return on capital are getting the bigger multiples, and CEOs are waking up to that, and they're coming and partnering with us, and they're repositioning their footprint. So I think corporate M&A is going to pick up. I don't think it's going to go back to the boom times, but I think the corporate repositioning story, we're already in one of the strongest bull markets that I've seen in my 35 years doing this.
I want to ask the difference between the Middle East and Asia, because you've been to both regions a couple of times already this year, and when I do a story on PE and doing a corporate carve-out, they always seem to have a Middle Eastern partner lately. And that's different from what we saw in China and Japan, right? So what's it like in Saudi and the UAE? What's the opportunity?
So I would say that region, and there's obviously a big conference going on there right now, I would say that region is going from being just an area where people raise money to one where people are investing in that region. You've seen that with the appointment of General Petraeus at KKR. We put almost $2 billion to work in the Middle East around fertility, aircraft leasing, as well as pipelines. So that area is starting to grow. The third point is what you talked about, which is Middle East entities are starting to invest and become part of the private equity mix, and you saw that with EA. I think there's going to be more of that. So I think that there's a leveling of the global competitive landscape, and it's about, again, how do you create operational improvement? How do you think about the strategic industries that you want to be in? Clearly, Saudi thinks that EA is a strategic asset, and so I think you're going to see movement around in terms of where capital goes, not just fundraising going to the Middle East and being handed off, but ultimately partnerships between U.S. firms, Middle East firms, other types of things like that, where people invest in that region. They need expertise in the region, they need capital in the region, but they also want to take some of their capital abroad, and that's really what we picked up on the ground.
Henry, thank you for being so generous with your time.
It's great to be
You're
here.
one of the best. Henry McVey of KKR. You're watching Bloomberg Open Interest. Another record, here we come, unless the Fed changes things when they have their decision. Look at this very cool function, IMAP, heat map. if you have a Bloomberg terminal, you get a sense for what's moving things, and shouldn't be any surprise what's moving things. The big green box on your screen is Nvidia. Shares are up 4.6%, hitting $5 trillion. Meanwhile, we'll hear from Microsoft, Meta, and Google later. This is Bloomberg.
Improve U.S. travel helps Booking Holdings. The parent company of Booking.com, Priceline, OpenTable, and more reported a better than expected reservations outlook, up about 7% on the year. Booking also topped quarterly estimates on room nights sold and gross bookings. The CEO, Glenn Fogel, joins us now. And Glenn, it's great to have you because we can get, I think, a pretty fantastic view of the U.S. consumer through your business. It looks very good, and yet we hear of a struggling lower end. How do you see it?
Well, I think that's probably right. And of course, we're a very global company, so we're looking throughout the world in what's happening in travel. But when you want to speak specifically to the US, you are correct. You got basically a two-speed economy here, where at the high end of the economic strata, things are going fairly well. But at the lower ends, there's more trouble there.
What exactly are you seeing at the lower end, Glenn? Is there any sign that that might bleed through to the upper end at some point?
Well, I think it's really best to look at some of the people who've already reported for our partners, our airline partners, our hotel partners. And when they talk about things, for example, that filling up in the airline business, for some reason, people talk about at the back of the bus. Of course, it's a plane, not a bus. But people talk about it having more trouble filling up those seats. Or people talk about at the lower end of the hotel chains, where you have multiple different brands. Some are more oriented to the lower end of the economic strata, where those are not doing as well as some of the high 4-star, 5-star hotels. That's what we see. Now, in terms of bleeding forward or not, look, we think things are good overall in terms of travel. We certainly see ourselves globally, so we don't concentrate so much on one particular country. U.S., by the way, we talk about this. We're talking low double digits of our total global demand. So for us, it's obviously want every country to do well, but for us as a company, it's obviously important for the whole world to do well.
So explain to us or illustrate for us then what your picture looks like. If the U.S. is only low double digits of the demand, which regions are the most important, or which that we wouldn't think about are strong for you?
Europe has always been our strong point. We've talked about that, roughly half the business or so. But when we did our call last night, we talked how we were so pleased that all our regions were doing well. We talked about the U.S. and Europe both doing high single-digit growth rates. And we talked about Asia, which is obviously a place that for a long time travel has been growing faster than others, that doing well. And we call the rest of the world. So Asia, rest of the world going low double-digit growth. So all in all, good third quarter numbers, but we also talked about how we see a steady demand for travel fourth quarter. So overall, we see things pretty good.
Where do people want to go? Where are the hot spots, not necessarily in the regions of customers, but where they're traveling to, Glenn?
So here's an interesting point, not so much where people are going, but where they're not going. And this goes back to talking about U.S. travel and what's happened to some of our supplier partners and some of the problems. The U.S. inbound, people coming from outside the U.S. to come visit the U.S. is down. And it's down actually significantly from where it's been in the past, whether last year or 2000, even before the pandemic, 2019, those numbers are down. And if you look at our travel lobbyist group, our trade industry group, they talk about how we are losing billions right now from what we could be getting because of problems of people not coming to the U.S. And some of the big ones are, for example, Canada. Canada to the U.S. down. Now, for us globally, that's okay for us because we're seeing Canada to Mexico up big. That's great. We're seeing, for us, in terms of people in Europe coming to the U.S., that's down. But for us, Europe to Asia is up. So for us as a company, we're okay. But as a person who lives here in America and wants our U.S. economy to do well, it's disappointing to see we are losing out on that inbound travel business.
Glenn, I wonder about a shift in priorities for the U.S. consumer, because I spent years living in Europe, and I know that they really prioritize vacation, going on a flight or a hotel, and also they have much better prices than we do. In the U.S., people had prioritized paying a mortgage and making a car payment. Now it seems like the car payment is slipping in terms of priority. Are Americans moving vacations up the list of priorities?
Well, I think that's something that a lot of people have been seeing, that over time, maybe the pandemic was the biggest thing that made the change of people preferencing more to do things, services, instead of buying things. So that certainly helps our industry, our business a lot when people decide, instead of buying another couch, I'd like to go on another holiday. That's great for us, and that definitely is happening. Perhaps part of it was because during the pandemic you couldn't travel, and people realized how important it is to them in their lives, and that's certainly something that we are definitely seeing.
Hey, Glenn, I was just thinking, we're showing video right now from Booking Holdings, and one of them, you can see it now, woman on her computer or on her phone with her credit card in one hand, dialing and making a booking. Is that going to go by the wayside? And I think, for example, of PayPal reaching an agreement with OpenAI, where you can have the PayPal wallet in ChatGPT and have ChatGPT buy stuff for you. Are we going to head into a future where AI all of a sudden is doing all of our booking decisions for us? And if that is the case, how do you convince an AI bot to use Booking or to have certain travel destinations promoted by you?
By the way, that's exactly the use case that we talk about in our editorial meeting as well, because we were talking about whether you use the agency of ChatGPT to buy stuff, and my first thought is obviously plane tickets and hotels.
Right. So what do you do in that environment then, Glenn?
Yeah, so obviously that is something you can't have an article or a discussion about travel without having Gen AI be right at the top of it. And we talked last night how happy we were to be in the first wave of apps at ChatGPT, where we had the Booking.com app right in there, which is great. And we've been working with them for some time. We were first out with their agent mode. We were out there with their operator system. And we're working with all the frontier players. So we're working with Gemini at Google. We're working with Alexa at Amazon. Everybody, we are currently working with them in different ways to be part of that very, very new way to do things in terms of using Gen AI to come up with more information. Here's the thing that's very interesting. There's a little bit of a big discussion around, well, what will these new Gen AI methods of discovery and inspiration for travel, and is that a threat to certain players? And look, there's no doubt some people are going to be using Gen AI, different companies, and they're going to go straight from there to a supplier like a hotel or a flight. But the fact is, travel is so incredibly complex. And yes, Gen AI helps a great deal, which is why we're using it so much, and why we have incredibly useful tools like Booking.com and our AI trip planner, which is based off of a large language model. So actually giving you a better experience, or whether or not you can go to our Priceline company, that's a thing called Penny, another thing, or using Open Table. And we have a thing that also is a way for people to use AI within our Open Table business to do a better choice what restaurant you want to go to. All throughout, Gen AI, incredibly important. The idea, though, that Gen AI is going to disintermediate a player like us, I find less possible. I think all the things we're going to do is just going to be done another way to get people a better solution to their travel needs. And of course, the whole execution is not just discovering what you want, and it's not just saying, okay, that's the one I'm going to get. There are issues of trust, there are issues of privacy, there are issues of regulations. It's a very complex world, and it's not so simple as that, oh, I'll just go on to a LLM and just say, I need this hotel, and it happens automatically. That's not going to happen for a long time.
Fair enough, Glenn. Thank you so much for joining us this morning. Glenn Fogel of Booking Holdings on the heels of their earnings. A quick check on markets this morning, heading towards another record high. The thing that's getting us there is Nvidia. After positive signals from President Trump with his meeting with President Xi coming up tomorrow morning in Korea time tonight, if you are here in the U.S. Nvidia now a $5 trillion market cap company, Matt.
All right, let's get a look at some of the other single stocks on the move.
Sorry, I stole your thunder.
Nvidia is a $5 trillion market cap. This, as President Trump touts Blackwell chips in his talks with President Xi.
Meanwhile, Boeing has announced a $4.9 billion accounting charge and delayed the debut for its 777X jetliner.
and had a loss of $7.47 a share.
Yes.
Caterpillar posted stronger than expected earnings and revenue, citing surging demand from AI data centers for its power generation equipment.
Coming up on the show, Kanye Anderson striking a deal in the healthcare real estate space. We're going to discuss an exclusive interview with the CEO coming up next. Kay Anderson and Remedy have acquired a $7.2 billion portfolio from Welltower, making them now the nation's largest owner of outpatient medical buildings. Joining us now is Kayne Anderson CEO Rabil, and their real estate business oversees about $19 billion in assets and investments in sectors including medical office, senior housing, and student housing. Al, wonderful to see you this morning. Thank you for joining.
Thanks for having me.
One time I had a conversation with a real estate investor who was like, forget about AI. I know infrastructure and real estate spending there is huge, but like the second biggest thing is real estate for an aging population. Just how big is this opportunity set?
It's massive. I mean, as you may or may not know, 18% of GDP goes to healthcare. You've got 11,000 Americans every day turning 65, 5,000 Americans a day turning 80. Also importantly, that's the baby boom generation, which is the wealthiest portion of the U.S. population. So just massive demand trends, really, for as far as the eye can see, which is what initially attracted us to the sector almost 20 years ago. And we've got decades of demand in front of us, demographically driven demand that is not going to stop anytime soon.
Yeah, I think Ed Yardeni estimated that the baby boomers have about $75 trillion in assets, and I've heard higher estimates than that as well. But the interesting thing to me is that this medical outpatient, these offices have become more and more prevalent, and doctors will steer you, or hospitals will steer you away to these centers now increasingly. How big of a trend is that?
It's a massive trend. In 2010, that's really when insurance companies changed reimbursement dynamics. So we had a hospital-centric system, which was massively expensive. And so insurance companies changed reimbursement rates to incentivize everybody within the healthcare ecosystem, doctors, patients, hospital systems, to use outpatient care. It's far more affordable. It's a better, it is a better outcome for everybody involved. So in 2010, 90% of healthcare was delivered in or around a hospital. Today, it's 90% is delivered outside of a hospital. So you have a massive trend. In 2010, 7% of total practitioners were employees of a hospital or healthcare system. Today, that's about 75%. 5 years from now, it'll be 95%. So this train is going down the tracks, and really what we've done is position ourselves in the middle of this massive shift in the healthcare ecosystem. So yes, we own real estate, and we own and manage and have huge strategic advantages with the real estate itself. But what we've really done is position ourselves as a true partner to these hospital and healthcare systems, aiding, assisting, and abetting them in better healthcare delivery.
And with this JV, as I mentioned, you become the largest owner of outpatient medical buildings. Maybe in the past that would have perked up ears of regulators. How much of this deal being possible to do is because of the regulatory regime that we're in right now?
This really doesn't fall under any regulatory dynamic because it's 44 states. We now control 53 million square feet, but there's nothing from a monopoly or oligopoly perspective that would impact this deal. I think it's important to note, you mentioned the 75 trillion. Matt, I've actually heard higher estimates, but it's a big number. And part of the dynamic is that we focus on the higher end portion of healthcare delivery. So our top 5 tenancies by specialty are orthopedics, oncology, neurology, cardiology, and diagnostics. So we are specifically tailoring our business to the highest margin businesses within healthcare, and specifically to the higher net worth portion of the U.S. population, which we deem to be the most recession-resistant, least volatile portion of an already low volatility asset class. I think it's worth noting that medical office over the past 20 years nationally has never been below 90.9% occupied. So I would say it's arguably, if not definitively, the lowest volatility asset class that exists in real estate. And obviously, going back 20 years, encompasses the GFC, the downturn in 2015, and the global pandemic.
How are prices right now? Because on the one hand, you have office and mall that are experiencing problems. We were talking today about the mall in Nyack. On the other hand, you have so many dollars out there chasing the same assets. And obviously, the real estate assets you buy are much more valuable because you're after the students, the seniors, and healthcare, right? Which is pretty recession-proof. But what are prices like?
That is the right question, Matt, because you can have constricting supply and massive demand, but the number one determinant of your return is your cost basis. What we've done is differentiate ourselves in this asset class by really positioning ourselves as a true partner to hospital systems. So we are talking to them about healthcare delivery all day, every day. We have a wholly owned subsidiary called Percival Health Advisors. So we are a strategic partner to hospital systems, helping them define their marketplace, gaps in their healthcare coverage, what private practices should they buy to fill those gaps, how should they fund that, what are the implications for their balance sheet, their income statement, their public credit rating. So what we do is very differentiated, which leads to a far better pricing dynamic for us, because the reality is that these hospital and healthcare systems want us to own their real estate because we help them in terms of their healthcare delivery, both in reducing cost, operating expenses, as well as expanding their successful practices and practitioners within their system.
Al, always great to have you in here. Thanks so much for joining us. Al Rabil there of Kayne Anderson talking about his latest deal. In just over 3 hours' time, Fed Chair Jay Powell is expected to cut rates. We're live in Washington to set the stage for that expected cut next. This is Bloomberg Open Interest.
The absolute level of rates in the U.S. is too high for the economy right now. You see this in the low to middle income spending, you see this in leveraged structures, and ultimately you see those in housing. Those are all critical variables to the economy. So I think the Fed needs to cut. I also think they need to signal that they're going to stop QT, and we'll probably do that at a level that's a lot higher than what we've seen in the past.
That was Henry McVey of KKR speaking with us ahead of today's Fed decision at 2 p.m. Eastern. Joining us now for more on what to expect is Michael McKee, Bloomberg's international economics and policy correspondent. And Mike, I always look forward to the Q&A when we see you step up and usually ask the best question of the bunch. What are you going to ask him today?
Well, there's a couple of questions that we want to get an answer to. Of course, the big thing that Wall Street wants to know is what are they going to do in December? I don't think we'll get much out of the chair, but it'll probably be asked a couple of different ways. And there certainly will be questions about QT, because 2 weeks ago, Jay Powell said, we still have abundant reserves in the system. We're getting closer to ample. And now, all of a sudden, everybody's talking about them ending QT because we're seeing this big take-up in the standing repo facility, and we've seen SOFR rates rise above effective Fed funds. So did they go too far already? That'll be another angle that people are going to want to know from the Fed chair. So there are a couple of different aspects to this that people are going to be caring about. But, of course, the number one question, Matt, is always, what are you going to do next?
And we will see what the answer to that will be.
What have you done for me lately? No, that's different. That's a different question.
I'm sure everyone wanted to hear Matt sing ahead of the Fed decision. Michael, thank you so much for joining us. Mike McKee there in Washington, D.C. Let's stay with the Fed decision. Any other songs for this one? Maybe no. Okay, yeah. Bond traders are looking to Chair Powell's remarks to determine their next move. Ira Jersey, Bloomberg Intelligence chief U.S. interest rate strategist, joins us now. Ira, it's been a bond market that's unmoved. Volatility is incredibly low as we zoom up on me. Thank you for that. Volatility is incredibly low. Is this a decision that could wake things up?
I don't think so, mainly because we're not going to get any more forward guidance, right? It's a foregone conclusion that they're going to cut 25 today, probably cut 25 in December. You know, the market's not convinced about January, although I think that they'll cut in January as well. So until December, I don't think the rate market is going to move a whole heck of a lot. But, you know, what Mike McKee was just talking about is what we'll be looking for. Is there a clue about the end of QT? And more importantly, from my point of view, is what are they going to do in order to kind of make sure that the funding markets, which I think it's underappreciated in their importance how funding markets are going to be stabilized and what they're going to do otherwise. So they're going to do, some other repos, and they're going to have to say that they're going to do other things, even if they're going to let the balance sheet run off for another month or two.
How key is that funding markets question in a time in which we are still kind of awash with liquidity, right?
Are we? That's the question.
If I look at M2, it's jumping back up again.
So the problem is that you have enough reserves until you don't, and it's a switch. It's not something that you can say, oh, we're going to have this easy glide path, and you're already starting to see some a little bit of fracture in those funding markets where reserve balances aren't quite high enough for the demand for reserves, and you also have a market where you have a lot of Treasury securities that are trying to be financed via repurchase agreements, and now what we're seeing really is mortgages. So when you look at that standing repo facility, 80% of the usage of it has been for mortgage-backed securities. So if you're worried about the housing market, you're worried about how people are going to continue to get mortgages, you need to have someone buy these mortgages and be able to fund them. And there seems to be some minor stresses there. Is it huge? No. It is a manageable problem right now, but it could get acute very quickly.
Haven't there been days recently where you've seen spikes up in banks tapping these facilities from the Fed? And what does that tell us?
Yeah, well, and you did this morning. $10 billion this morning in the standing repo facility, and then there's going to be another operation later today, which I suspect will also get tapped. What that's telling you is that there's barely enough reserve balances and barely enough liquidity to fund all of the activities that financial markets need to be funded. And like I said, we remember back in September 2019, you had repo rates for a couple of trades spike up to 9% on, basically on one day because we didn't have enough reserves. And that's the risk right now. We have maturities and then $25 billion of T-bill, net T-bill activity that settle tomorrow, another 50 billion-ish on Friday of coupons that settle, and all of those things require funding. And if there's not enough funding, you'll wind up seeing some angst in these funding markets, and that's something that Powell really has to address today.
All right, Ira, great to have you on the program. You can find Ira's research on the Bloomberg terminal. Just type BI-GO or BI rates if you want to get specific. Don't miss our special coverage of the Fed decision kicking off at 1:30 p.m. New York time. Coming up tomorrow, Stefan Slowinski of BNP Paribas reacting to big tech, plus Lauren Goodwin of New York Life Investments and Catherine Bordelmay of Goldman Sachs.